In this section, we will explore the reasons why Europe's economy and markets could outperform the U.S. in 2023, such as the expansionary fiscal policy, the reopening of China, the diversification of sectors, and the shift from growth to value stocks. First, let's talk about the fiscal policy. Europe has been in expansionary fiscal policy mode for quite a while, especially due to the energy crisis. This means that the governments have been spending more money to stimulate the economy and support households and businesses affected by high energy prices. This fiscal stimulus has boosted domestic demand and helped Europe recover faster from the pandemic-induced recession. In contrast, the U.S. fiscal policy has been more constrained by political gridlock and debt ceiling issues, limiting its ability to provide further support to the economy. Second, let's look at the trade situation. Europe is also betting on the reopening of China, and it is going to give positive tailwinds to the European growth story. China is a major trading partner for Europe, especially for Germany and France, which are the largest economies in the Eurozone. China's economy has been slowing down recently due to its zero-COVID policy and regulatory crackdowns on various sectors, but it is expected to rebound in 2023 as it eases some of its restrictions and boosts domestic consumption. This will benefit European exporters of goods and services, such as machinery, cars, luxury goods, and tourism. Third, let's examine the sector composition. Europe has a more diversified mix of sectors than the US, which makes it more resilient to shocks and less dependent on a few dominant industries. For example, Europe has a larger share of industrial, consumer discretionary, and financial stocks, which tend to perform well when the economy is expanding and interest rates are rising. The US, on the other hand, has a higher concentration of technology, healthcare, and communication services stocks, which are more sensitive to valuation changes and regulatory risks. Fourth, let's discuss the style factor. The shift from growth stocks to value stocks also gives a little bit more opportunity to Europe compared to US. Growth stocks are those that have high expectations of future earnings growth, such as the big U.S. tech stocks. Value stocks are those that trade at low prices relative to their fundamentals, such as earnings or book value. Growth stocks were hit hard in 2022, as the U.S. Federal Reserve raised interest rates, which hit future earnings expectations. Value stocks, in comparison, tend to outperform as rates rise, as they benefit from higher inflation and stronger economic activity. Europe broadly possesses a higher proportion of value stocks than its global peers, which gives it an edge over the U.S. in this environment. To sum up, we have seen that Europe's economy and markets could outperform the U.S. in 2023 for several reasons. Its expansionary fiscal policy, its exposure to China's recovery, its diversified sector mix, and its value orientation. These factors could make Europe a more attractive destination for investors looking for growth and value opportunities. In Europe is facing a number of challenges and risks in 2023 that could affect its banking sector and economic performance. Some of the main ones are the war in Ukraine, which has escalated into a major geopolitical confrontation between Russia and the West. This has increased tensions, sanctions, and uncertainty in the region, as well as disrupted trade, energy, and security ties. The war could also trigger a refugee crisis and a humanitarian disaster. The energy crisis, which has caused a surge in gas and electricity prices across Europe. This has eroded consumers' purchasing power, increased inflation, and strained public finances. The energy crisis has also exposed Europe's dependence on external suppliers, especially Russia, and highlighted the need for more diversification and resilience. The inflation pressure, which has reached its highest level in decades. This has eroded consumers' and businesses' confidence, reduced real incomes, and increased borrowing costs. The inflation pressure has also challenged the monetary policy of the European Central Bank, ECB, which has to balance supporting growth and containing price expectations. The uncertainty of the COVID-19 pandemic, which has not been fully overcome despite the progress of vaccination campaigns. The pandemic has posed health risks, social challenges, and economic disruptions. The pandemic has also widened inequalities, increased poverty, and exacerbated mental health issues. 10. These challenges and risks pose significant threats to Europe's stability, prosperity, and cohesion. They also require coordinated and effective responses from policymakers, businesses, and civil society. Europe needs to strengthen its resilience, solidarity, and innovation to overcome these difficulties and seize new opportunities.